Good afternoon, everyone. This is Robert Rayburn here at Life Pro Asset Management. It is March 4th of 2024, the last month to the first quarter. It really does feel like yesterday that we were talking about the new year and wrapping up 2023. And certainly as myself gets older, it seems like time goes by faster and faster. But the good news is we are off to a good start for the year, both market-wise, strategy-wise. And if we look at the economy, things remain humming. And I think that's really the message of today is that there's a lot of fear out there. There's a lot of naysayers out there. It could be about the economy, about the US, about our political process. But the good news is the market kind of looks through a lot of that noise, and the economic machine of the US that is envied by the world continues to click along. And the reason why the US remains the envy of the world is that the economy is bigger than the political machine. The economic machine steers the political machine versus the other way around, as we see in countries like China or Western Europe or in the Middle East. And that's what really sets the US apart. And I think that's a big reason why you continue to see US markets outperform over a long period of time versus other foreign markets. So let's go ahead and get started like we always do. I'm going to go ahead and share my screen. And the title of this week's presentation is To Avoid Those Rotten Apples. And I say that tongue-in-cheek a little bit because the truth is market conditions really do remain healthy. But underneath the surface, there are the haves and the have-nots. And what are the haves and have-nots are starting to change. We talked about how the top of the market was really dominating performance in 2023, really dominated by the Magnificent Seven. That Magnificent Seven is now sort of becoming the Tremendous Four and maybe the dynamic duel of NVIDIA and AMD, or what other semiconductor chip, or Eli Lilly on the healthcare side you want to add in there. So that dominant group is becoming narrower, and more members of that Magnificent Seven are starting to deteriorate, break down, and that money is starting to shift into other areas of the market that are cheap, that are pretty interesting, that are forgotten, that represents significant upside in our opinion. So we see that with Apple. That price action continues to deteriorate. It's interesting because it's the one name there that has really not done much on the AI side within the Magnificent Seven, outside, of course, of healthcare. So we want to pay attention to that. It's a big component, second largest company in the world. Not that it means anything for, say, the market as a whole, but it means something for indexers and how they're going to generate return, because Apple's such a large component of many passive indexes. Lastly, what do we believe is driving this recent energy breakout? Of course, if you've paid attention to our updates, we are mega bulls on energy, both short and long term, but in particularly long term. We think the fundamentals are fantastic. The valuations are dirt cheap, cheapest in the market, quite frankly. And the supply-demand picture continues to tighten up. And we don't think that's going to see much relief anytime soon as the global economy continues to click along. In terms of recessions, the one area of the economy that had been weak was manufacturing. Well, guess what? New orders are skyrocketing. And this is a good leading indicator as to what we'll see in those ISM manufacturing numbers next month and the month forward. It's not perfect, right? Sometimes you can have anomalies, but when you get new orders that are picking up, it's really hard to see how the headline manufacturing number is going to deteriorate, because new orders are orders on paper. That becomes orders in the factory a month or two in advance. So that's something here that it's just really hard to see when you see a chart like this, to say, hey, like, we're about to head into a recession. And we can go through the employment numbers, and we can go through the income numbers, and we can go through the service numbers and earnings and all this stuff. There's other types of stuff. Sometimes you just have to go through one chart. And, I get it. There's a lot of pessimism around the election, but the economy really does remain in pretty good shape. The other thing I would add is, of course, that when you get two strong months in a row at the beginning of the year, so what I mean by that, when January and February are off to a strong start, historically, that's very positive for the market. So what I want to show here are the 15 best starts of the S&P 500 going back the last century or so. And what you can see is on average, when you're up 5.4% for the first 2 months of the year, you're up 9.9% from the end of February through to the end of the year. Why is that? Because a lot of capital allocators are making bets on the rest of the year at the beginning of the year. It sets the tone as to how a lot of these big institutions are positioning. Now, does that mean the world can't flip on a dime and suddenly people go risk off? Of course. Let's look at COVID in 2020. January was a great start. First part of February was great. And then boom, you got this huge wave of COVID that swept the world and we had that risk off. But what's interesting is the year ended off well, right? Even in 2020, when you had COVID shutting things down, the market actually did recover in the back half of the year. So again, when you get a good strong start to January and February strung together, does tend to be a good leading indicator for positive returns throughout the rest of the year. Now, does that mean you can't have a correction in between? Absolutely not. Most years in bull markets, you can have 1 to 2 stock market corrections, which are defined as 10% pullbacks. So that's, we're not saying that can't happen, but as a whole, for the entire year, things look pretty good, and the data kind of backs that view. Underneath the surface, things remain calm. When you start to see markets deteriorating, you'll start to see an expansion of the percentage of stocks at 20-day lows, as shown by this chart here at the bottom. So as the percentage of stocks at 20-day lows starts to expand, it really acts as cracks in the market, right? So you're starting to see more and more stocks that are deteriorating, that people are fleeing. What happens typically if you sense a correction is coming, you sell your riskiest stocks first, and then the healthiest stocks or the most defensive stocks are the last soldier standing. What we're not really seeing right now, even though the market is overbought, right? I mean, and remember we talked about bull markets spend most of their life being overbought. So even though it is overbought, we're not really seeing the symptoms that are suggestive of something that more nefarious at hand, right? That would suggest a wave of weakness that is about to envelop global markets. So the percentage of stocks at 20-day lows at a very, 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 very low level, even though we're in a overbought condition. So overall, the bottom line message of this slide here is that the internals remain healthy. We have expanding breadth throughout the market. We have no expansion of 20-day lows, as we just reviewed. And cyclical stocks are outperforming defensive stocks. Another way to think about that is economically sensitive stocks that rely on a good economy are outperforming stocks that outperform during recessions. And again, that is a symptom you want to see if you're long risk or you're long stocks in general. One area where we have not seen that vote of confidence is in Apple. People are very long Apple, and that's mostly through indexes, but you have a lot of investors that have been sitting on significant gains over the last decade or so. And so there's 3 things that concern us about Apple. One is the weakening relative strength. So we can see here, this chart on the bottom is Apple relative to the S&P 500. And what you see here is a stock that has not created any outperformance or alpha for institutional or retail investors, really going all the way back to, call it 2021. So you have a stock that has stagnated. And the fundamentals kind of align with that. You've had no revenue growth or any AI strategy to speak of. And I think there was something that happened this week or last week, pardon me, that brought to the surface the challenges that Apple is having with artificial intelligence. They shut down their autonomous car unit. And instead of firing those engineers, what they did is they shifted those people over to their AI initiative. Now, one may say, oh, great, you're putting more brains to focus on AI. But what that also might be suggestive of is that AI didn't really have a lot of people behind it. There may not have been a lot of resources dedicated to artificial intelligence. So now they're shifting these people over to the artificial intelligence unit, and they don't really have anything to present to their customer base. They don't really have any AI strategy at all. And when you think of the stocks that have been ripping, and obviously we're trying to avoid those areas, so we think they're expensive right now, but from a business perspective and a technology perspective, it's quite clear that Apple's behind some of their competitors, such as Microsoft, uh, maybe not as much Google, but NVIDIA on the hardware side. And so AMD as well. So there's just not a lot of breadth there or depth to their AI strategy. So that's number two. Number three is an expensive valuation. So you got a stock right now with no revenue growth. Their latest product, the headset, is about $3,000. Not a huge addressable market with that price tag. And you got weakening relative strength and a potential double top in the technical charts here, as we can see here, denoted by these arrows. So that's concerning. And you have a lot of people that are long. So that is not a good setup for this bellwether stock as it relates to the ETFs that are driven by a handful of large stocks such as Apple or Microsoft or NVIDIA or Google, et cetera. So we want to keep it. I think it's important to keep an eye on that. It's not just Apple. Google has similar price action a little bit earlier in the move, weakening relative strength again to the S&P 500 as we see here in this middle chart, slowing revenue growth, and of course crowded positioning as it relates to retail investors, institutional investors. Almost everyone we know is long to some extent in some way long Google. And quite frankly, it's really screwed up its AI initiative. If you, not to get political in any sense of the word, but if you look at how they rolled out their AI search tools and the results that have been coming up, it just kind of was a big juicy softball for people to crank out of the park that want to be critical of Google. And so they have a lot of work to do reputationally on the AI front. They've already had issues in the past as it relates to that. And anytime any of these companies goes down a political wormhole, you got to be concerned in this type of environment, especially leading into an election. The other thing I want to be mindful of are some of the other messages that are kind of backing this movement away from stocks like Apple and Google. So IWM are the small cap stocks on the NYSE. And we can see here is that small cap stocks are starting to outperform Apple. Why is this important? Because Apple's market cap at one point exceeded the entire market cap for all the small cap stocks on the NYSE. That's beginning to shift again as people realize, hey, these small cap stocks are actually quite cheap. So it's a little bit early to say that small cap is leadership, but certainly this price action is suggestive of a potential shift that we're seeing underneath the hood of the market. We're seeing the early signs of that against small caps relative to the NASDAQ, right? So this chart in itself, if it was in isolation, I would say, I need to see a little bit more here. But when you combine it with the Apple chart, when you combine it with the Google chart, when you combine it with small caps outperforming Apple, and now the small caps trying to outperform the overall NASDAQ, I think that's something to pay attention to. With small caps breaking out and that potential bottom versus NASDAQ, that's something I think we need to make sure we're not overlooking. And then on the defensive side of the market, those recession-proof stocks, again, no improvement here. We continue to see that deterioration of consumer staples, utilities. Again, versus the market, you're seeing that clear deterioration. People are not interested at the institutional retail level to gain exposure to recession-proofing their portfolio. That says something. It's a symptom of what the market is trying to tell us. Remember, this is something we try to do. And we've largely done a good job of this throughout our history. 2022, we didn't do a good job of that, and we're trying to get back to basics. Let the market try to communicate to us. What's it trying to tell us? And when I look at this chart, I look at a market that's trying to tell me I'm not overly concerned that I need to recession-proof my portfolio. I need something that's a little bit more offensive in nature for my investments. So where do we see value? We've shown this slide before, but banks, energy companies, emerging markets, and then some of these orphan growth stories such as cannabis and China. Energy, big week this week. I know for some of our investors that see moves in the video, they're like, well, why do we own so much energy? Weeks like this week are why we own energy. When we look at the energy sector relative to the S&P 500, or no, sorry, relative to the S&P 500 from a seasonality standpoint, this is about the time of the year that energy stocks start to pick up versus the market. And you can see that denoted here. We're about 40 trading days or so into the new year. This is where you start to get the outperformance of energy stocks. Why is that? It's simple. The spring driving season, the same reason why retail stocks tend to outperform in Q4 because of Christmas. Energy stocks, rightfully or wrongfully, tend to outperform in late Q1 and early Q2 of the year. Why? Because you get the spring driving season, and that tends to peak out in Memorial Day weekend and Independence Day. Now, we think we're in a longer term secular bull market for energy. And it's interesting. No one's talking about this, but we've now broken above $80 a barrel. Energy companies make a lot of money above $80 a barrel. I forget who it was, but someone said every single day that oil is above $80, it's Christmas for the energy companies. It's a blessing. And so we don't disagree at all. Lastly, what I want to point out is China. Absolutely incredible, right? So for all this talk that China's overtaken the US and all this kind of stuff, let's take a step back and say, what is the market trying to tell us? Over the last 30 years, Chinese stocks have returned to investors 0%. Annualized, on an annualized basis, China's returning 0%, total return 0%, and the S&P 500 annualized is returning 10.4%, right? So that's obviously resulted in many times over your money over the last 30 years. You just have to look at where the Dow was, something like, what was it, like 4,000, 5,000 in the late 90s before it hit that 10,000 mark. So, it's incredible what the U.S. market continues to do, what the U.S. economy continues to do. We're the leaders in AI innovation, and that is going to be a huge boom for productivity. We're very interested in seeing which companies are going to be the applications built on top of the AI hardware platform that's being built out right now. That's where we really see the value, and we're holding our gunpowder for that. But with China, the flip side to this is that you're starting to get this 3-year bear market that we've seen in China, where Chinese stocks have sank 55%. You're starting to get some really good companies that are really, really cheap. Companies like Alibaba or JD or Baidu or Tencent. These are not rinky-dink emerging market companies. These are global leaders that are trading sub 10 times earnings. And so we need to pay attention to that. At some point, we think that value will come to the surface there. So we've been increasing our exposure to those types of companies. So in summary, we want to avoid those rotten apples. The U.S. economy really does look fine. Try to avoid some of the bear porn out there as it relates to people looking for the end of the world. If you're looking for the end of the world, you'll find it. Trust me, it's out there. But the data looks pretty good. Market internals are acting well. We don't see any yellow flags right there. And then lastly, weakness at the top of the market, but strength across the rest of the market. And I think that's important. So that's what we got for you this week, 888-543-3776. Please feel free to reach out to your advisor if you have any questions, and have a fantastic week and a happy March.